right, welcome to the Airman Roundtable. Today is the 17th of January, 2025. Special friend Scott Ruble from Strategism Trade is back. He's going to tell us about his new mini class coming up with portfolio hedging, which I guess is how Warren Buffett does so well. So that's the idea, right? To slowly grow your wealth. So always a pleasure, Scott. Welcome back. Nice to have you here for the new year.
Oh, happy New Year, Tom, and everybody here. Happy New Year. So, as Tom was saying, we're having a mini class next Saturday, not this Saturday, next Saturday, on portfolio hedging, and it's kind of a unique little thing that I'll go into, and I won't keep you guys long because it's pretty straightforward. But before we go any further, I have to go through the disclaimers. Please read Tom's disclaimers, but this is our disclaimer. It just says we're giving out education, not advice. And by participating in this class, I'm sure Tom agrees that you have to agree to all the disclaimers. Otherwise, log out and contact us or Tom, and we'll figure something out. But I want to thank Tom for hosting this event. He's probably the most gracious person in this industry and does a fantastic job. But let's just jump right into it because I know the markets are open and people are wanting to trade. This being like a pretty big up day again.
Yeah, we're up 75.
Are we?
Well,
Mm,
70 now, but yeah, it was
okay.
up 75.
Yeah, yeah. Fun day. We're just flirting with 6,000 in the SPX again. But that being said, let's get started. And as Tom stated, we are having a mini class on the 25th. So a week from tomorrow. And it's this is a really weird phenomenon that occurred because I taught this same strategy a couple years ago and everybody was bored. And I didn't teach it in a mini class version. I taught it in a pod class. And for those who don't know, we have weekly classes, usually on a Wednesday, unless the Fed's meeting called pod. And they're 90-minute classes at 7 o'clock at night. And we just cover a variety of topics. And I covered this strategy maybe 4 or 5 years ago, but we were having so much fun doing so many other things that I think a lot of students just were bored by it and preferred regular collars as opposed to more sophisticated or what they deem complicated, but it's actually not complicated strategy. So this week coming up, we have the markets closed on Monday, and then we have the mini class at the end of the week, and that's what I'm going to be talking about tonight, and exactly what portfolio hedging is and how Warren Buffett trades. So the best way to actually describe what I'm talking about is just to go and tell you a little story and about how this class even came about. And out of nowhere, this was really serendipity. It was a big shock and a surprise to me because we had a class back in November called Which Strategy When, where we went through every single strategy known to man in terms of option trading and said what conditions are best for each strategy so that you're not buying volatility on high levels or selling it on low levels, etc. And the class ended the first day at 3 p.m. But I said, like I always do, I'll stick around and answer questions as long as you want. Just because the class is technically over with today, I'm not going anywhere. If you got questions, hit me with them. And then about 4 o'clock, 4:30, someone asked me about a platinum hedge with a portfolio of stocks. And we just from there went way off a topic of what was part of the mini class, but it didn't matter because it was in the question and answer section. So I just went off on this huge tangent, even though it really kind of applies because it is a strategy and you want to know when to trade it. So one of the things I brought up at the time is I said, okay, you guys are picking stocks. Who's the best stock picker in the world? Who do you think does the best job at picking stocks? And unanimously, almost unanimously, everybody came back and said it's Warren Buffett. A couple more sophisticated people said Peter Lynch, and a couple people said, had other names, but 95% of the people said Warren Buffett. And I went on, and what may have been perceived as a rant, but it wasn't meant as much because there's a lot of respect you got to give Warren Buffett. The respect I give him is not in his stock picking, though. I think he would have been better off over the long run just throwing darts at a dartboard because I asked the students, what's his biggest holding right now? And a couple people said Apple, but he got out of most of his Apple stock. So it was debatable if his biggest holding is Coke, which historically has always been his biggest holding, or if now he holds a little bit more Bank of America than Coke. I'm not sure which, but Coke is still either his first or second biggest holding. And I said, okay, if he's such a great stock picker, let's take a look at Coke for the last 2 years. And here's a graph of Coke for the last 2 years. And as of yesterday, for the last 2 years, Coke has been exactly unchanged. If you bought Coke 2 years ago and looked at it last night, you'd see it was exactly unchanged. As a matter of fact, the market was up pretty big. Um, what was it? Not yesterday, but the day before, and Coke was still down like 15 cents. We were up like 70 or 107, excuse me. We were up 107 in the SPX, and Coke was down a few cents. Like, how would you like to see the market be up 2% and you're down a quarter of a percent? Not the greatest pick in the world. People say, well, what about longer term? Okay, here's 3 years of Coke. Again, exactly unchanged over 3 years. Now, to put things in perspective, you have to look at what the SPX has done for the last 2 years. When you own Coke instead of a different stock or a major index, what did you miss over the last 2 years? You could have just bought the SPX, sat, and made 56% in the last 2 years. So that brought up the question, why does he not get rid of Coke? What is the purpose of him owning so much Coke if it's consistently underperforming? And I mentioned to the whole class that the genius in Warren Buffett is not his stock picks. His genius is how he hedges and manages his portfolio of stocks. Now, Warren Buffett could afford to own all of Coke. He could just go out and buy the entire company, but instead he's got Coke, he's got Geico, he's got Burlington Northern, he's got Dairy Queen, he's got See's Candies, and he's got 10, 15 different stocks in his portfolio. And guess what that creates when you have 10 or 15 or 20 stocks? It creates your own little index. And that's what he wants. That's his goal and objective is to have an index that he creates that closely mimics a larger index that he can use to hedge and uses that in a way that can outperform the market as a whole. So let me give you an example. During that class I talked about back in November, out of nowhere, this thing just blew up where literally people who were not even in the mini class heard about what I'm about to show you right now and started contacting the office and saying, look, how do I get into this class that Scott's talking about with Warren Buffett? I don't even know how they heard about it because they're not in our database. They're not our students. They weren't in the mini class, and yet they somehow heard about it. And this thing is blown up to be our biggest class ever. I mean, this is going to be bigger than any class I've ever done. And I think we only got a couple seats left. I mean, I'm not even trying to sell it. I really don't care because it's probably oversubscribed and we can't, take any more people by the end of the week. But I literally just said, okay, guys, let's do a Warren Buffett trade and I'll show you how easy it is. You pick 5 stocks, and the students rattled off some names. And I just took whatever names they wanted, and they came up with Dell, AVGO, NVIDIA, AMD, and Amazon. I said, okay, now that you picked your stocks, tell me how many shares of each of them you want. You can make this portfolio as big or as small as you want. I am not going to give you any parameters. Probably like most of your guys' retirement accounts, where one year you bought 100 shares of PLTR because that was a hot stock. And another year you bought 100 shares of NVIDIA and you bought 300 shares of Apple. And you end up with this portfolio. We're going to do the same thing. So this is literally the image I created real quick because I'm in the middle of class. Was unexpected that this was even going to come up. So this is just down and dirty chalkboard stuff, nothing fancy, nothing really even visually easy to understand. I just pulled up a spreadsheet and this is what the students came up with. They came up with in this center column in the box here, you see, they wanted to buy 800 shares of Dell, 800 shares of NVIDIA, 700 shares of Amazon, uh, 800 shares of Broadcom, and 800 shares of AMD. And I'm like, well, this is a pretty big portfolio. It comes out to be about $600,000. If you want, you can lop a zero off of these and have a $60,000, you know, uh, portfolio. But let's take a look. Let's say you end up over a couple years with these 5 different names. What are you going to do if you're nervous that this market is at all-time highs again and may correct? And the student said, well, we're going to go hedge it. And I go, okay, how are you going to go out hedging this? And they said, well, I'll go into Dell and buy puts in Dell, or I'll collar Dell. Great, let's do that. I said, what is your deductible? In other words, how much are you willing to lose on Dell before your put kicks in? Now, you can buy an at the money put, but it's going to be expensive. Just like you can buy car insurance with no deductible, and it's going to be expensive. Some people say, I don't care what the market's going to do, it's going to bounce around. But if it falls more than 10%, I want to be hedged. Other people, 5%. You have William, O'Neill, who's got his different percentages, and everyone's got their own thing. Students came up with roughly 7%, 7.5%. I said, okay, so let's go and buy a Dell put that's about 7.5% out of the money. And an NVIDIA put that's about 7.5% out of the money. And an Amazon put that's about 7.5%, etc. Now, we're not going to be able to get exactly 7.5% because of the strike prices versus where the stock is at, but we'll get close. Maybe we'll get 6% on one and 8% on the other, but let's go out and hedge. And this is what we did. There's about 7.6% on an average out of the money where our hedges kick in. And you can see that this portfolio actually kind of matches up with the dollar value of the S&P 500. Because at the time, the SPX was at 59.08 with its 100 multiplier. Each put in there would protect about $590,800 in stock. And I said we could also go into the QQQ, but because of the size of the QQQ, which was only $496 at the time, we would have to do about 12 contracts to get the same $590,000 of protection. But going into the individual names, buying puts in those individual names was going to cost about almost $10,000, $9,841. And I'll show you why. Here's Dell. The stock was at about 131 at the time. Now, you'll see the blue box there where that was the last trade of 131.64. But what I did not take a picture of is the aftermarkets, which is what we were looking at because It was a weekend when we were teaching the class, and the stock had really closed at 131 in the aftermarkets. It settled at 131.64 on Friday and was at about 131 on Saturday in the aftermarkets. So I said, okay, with the stock at 131, we can do the 123 strike put. It's about 6% out of the money. And you see that that's going to cost $4.05. Then we do the same thing in the video. And this is about 6.5% out of the money, and that's trading for 620. We did 700 shares of Amazon. We're going to have to buy 7 puts at the 190 strike for $1.35. Then we have to go into Broadcom. And we had 800 shares of that, so we're going to have to buy 8 puts for $1.39. And the same thing with AMD. The AMD puts were going to cost us that we're about 7% out of the money, $1.48. Now we could have gone down to the 120 strike, but that's way out of the money. That's $14 out of the money. It's going to be way over 7%. We could have gone up to say the 130 put, but that's only about, 3% out of the money, and it's going to cost us 279. So we chose the 125 strike as a compromise. And all that came out to be, when you add them up, 8 contracts of Dell, 8 contracts in NVIDIA for 420, 7 contracts of Amazon for $1.35, etc. All that came out to be a total of $9,841 in puts we were going to have to buy. That's a lot of money, especially considering these were 20-day options. If we wanted to go 2 months, 3 months, 8 months out in time, the cost of the insurance would have been astronomical. Now, everybody here is pretty astute. Tom's got some really bright students. So I'm sure everybody's thinking, well, it's not really going to cost me 10 grand because I'll just collar it. Okay. You're absolutely right. And I would do the same thing. I don't want to pay out 9 grand for insurance for 20 days and watch it go out worthless, because the market has to go up a lot to make that 10 grand back. So I'll collar it. Now, when we're talking about collars, an oversimplified and very remedial approach is keeping in mind the normal distribution curve with time premiums. Whatever the percentage out of the money our put is that we're going to have to pay 424, if we go about the same percentage out of the money on the other side to sell a call, we'll get about 420. And we can have on a cashless collar. And that seems to please most people. For very new people to trading, or people very concerned about debits and credits, this is a very acceptable way of trading that makes them very comfortable. Now, they hate giving up the upside when they sell that call, because they forget about all the times the puts saved their lives. They only seem to remember the time that the stock went up 10% that month and they had a call, and that call limited how much protection or how much profit potential they could make. And I understand that. I get the same emotion going. I'm like, this is the one time I probably shouldn't have sold the call, but you don't know. That's hindsight. So after you go in to Dell and buy a put, and then you go into AMD and buy a put, and then you go into Broadcom and buy a put, NVIDIA and buy a put, and then you go and collar it and sell a call in each one of those. You're pretty exhausted. You've done a lot of work, and guess what? The stock hasn't even moved. That's not even the real work. Once the stock starts moving, you have to make all the adjustments and everything. If the stock starts going up big, you're going to want to roll your calls so you don't limit your profit potential. And as the market goes up, you're also going to want to roll your put up to lock in some of those profits. And if the market goes down, you have to figure out what you're going to do with your hedge. This whole process of hedging 4, 5, 6, 7, 9 stocks in 9 different names every single month or every few months is exhausting. It's an accounting or bookkeeping nightmare. It's easy to forget about stuff, and it's suboptimal. A better way of doing it, there is another way. We can do it the way I just described and the way most people, or we can do it a more efficient way and hedge with an index and go 7.5% out of the money or 5% out of the money or 2% out of the money and hedge with an index. Now, what we chose in this class, just as a pure example, there's a better trade than this, but I'm just using the example we talked about in the class so that anybody who was in the class knows I'm just telling the truth and not embellishing or anything. We went out and looked at the 54.60 put for 830. One put for 830 protects about $590,000 a stock. And you see that we have about $590,000 worth of stock. So here's our stock, and one SPX put does a pretty good job at protecting the whole portfolio. So instead of spending $9,841 on puts, we can buy one SPX put for $8.30 or $830. Okay. So let me erase this. Okay. So if we chose to go into the QQQ index because it more closely matches with the names we had, which are mostly NASDAQ stocks, Dell, NVIDIA, Amazon, AMD. The NASDAQ is more high tech, and pretty much all these stocks were high tech. So I'd probably go into the Q. It's going to cost me slightly more because this index is a $500 index instead of a $5,000 index. Each contract is not going to protect a $500,000 of stock. Each contract is going to protect $49,657 of this index. And so to protect $598,000 worth of stock, you can see at the math at the bottom, we're going to have to buy 12 puts in the QQQ. But even if we buy 12 puts in the QQQ for $1.65, 12 times 165 comes out to be $1,980. We're going to spend $1,980 on our hedge instead of $10,000. Now, the first question people are going to have is, well, what if I buy puts in the NASDAQ and the market as a whole goes up, but NVIDIA goes down big? Won't I lose money? And in the mini class, I'm going to show you a million different studies, which is a slight hyperbole, but I'm going to show you different studies that shows that if you have a well-diversified portfolio and you pick the correct index to hedge in, there is a dramatic correlation between what the index will do as a hedge versus individual names. In other words, some of you guys may have heard of basket trading or portfolio trading, where Guys go out and trade a basket of S&P 500 stocks against the S&P 500 and arbitrage the difference between the cash and the future when it gets out of line. When people first started doing that, they'd go out and buy 500 stocks and sell a future and consider themselves perfectly hedged. Well, there's been thousands of PhD dissertations showing that you don't need to go out and buy 500 stocks in the S&P 500 to perfectly match the S&P 500. The top 6, 7, 8 stocks in the S&P 500 have a big enough correlation that if you just do the top 8 stocks in the S&P 500, it has a 99% correlation with the index as a whole. And you don't have to trade the other 492 stocks. It will act almost exactly the same as the index as a whole. So finding the right index to hedge with is imperative here. Now, what is really cool and what is very interesting is what comes next. Let's say you have 8, 6, 7, 4, whatever stocks, and you decide you want to hedge with an index because instead of going into 7 names, you only have to go into the SPX or the QQQ or the NDX or the stocks or whatever. That's just where the fun begins. But here's some takeaways from this. We created a portfolio that was about $600,000. Now, people just got big because it was a mini class. They weren't actually buying the stocks, so they wanted to be big. But we could have done this with a $20,000 portfolio. And I think we're going to do this with about a $20,000 or $30,000 portfolio right after the mini class. And you don't have to have a big portfolio. The returns will be the same. But we had 3 choices. One, once we buy all those stocks, we can hedge with an index put versus an index call, meaning we can collar this in indexes. The downside to collaring with an index call is that you can't sell an index call naked, even if it's against the stocks in the index, because your brokerage firm won't match them up and say they're perfectly in alignment. Instead, we'll just have to sell a wide call spread. The broker just wants to see that you have a finite loss if the market goes to infinity in that index. Well, you hope you have maximum loss on that call or call spread because it means your stocks went through the roof. And this is a good way of doing it where if you want a zero cost hedge, an unlimited upside profit potential, because all you can lose is the distance between the strikes on the SPX or QQQ call spread, but your stocks can go up dramatically. You could be in a situation where your Tesla went from 350 to 500 in a month just because somebody won an election. Another way of doing this is we could do an index puts and say the QQQ or the SPX and sell a couple equity calls, just enough equity calls to get the cost of our puts back. Now, what that's going to do is let us be in a dollar neutral position, but almost unlimited upside potential. Another thing we could do is buy the index puts or put spreads or whatever and sell an equal number of equity calls, meaning every 100 shares of stock, we sell a call in AMD. So we saw we had 800 shares of AMD. We sell 8 calls in AMD. And what does that do for us? Here's where the beauty comes in. Pay attention, guys. It's going to look like, it's going to look and feel like magic. We will take in in this example that we were doing, we'll take in a $7,861 credit monthly, which on our $600,000 portfolio is about a 1.3% monthly credit. When you annualize that, that means it enhances our returns just from our hedge portion, 15.7% per year. So people ask Warren Buffett, how do you always outperform the market? You've got to be the greatest stock picker in the world. In a year where the market is up 20%, your stocks must have been up 28% or 30% because you're beating the market every time. Well, we saw how well Coke did. Last year, the market was up 23% or whatever. Coke was unchanged. How did Warren Buffett do so well? A lot of it has to do with his hedges. He's taken in credits. For example, let's go back to this. Okay, here, this is the best way looking at it. Here, we saw that we would have bought $10,000 worth of puts if we hedged with puts in the stocks, but we didn't. We went out and bought an SPX put for $830 or a QQQ put for $1,980. 12, total 12 for 1980. Now, let's say you only want that $1,980 back. What do you got to do? Well, we have, remember, 800 shares of Dell, 8 puts, so we could sell 8 calls. But let's say we only sell 2 calls at $4. And in NVIDIA, we have 800 shares. We could be buying 8 puts, so we could be selling 8 calls. But instead, we only sell 2 calls. So if the market runs up, we will be limited on how much we can make on 200 of the 800 shares, but the other 600 can keep going. And let's say on Amazon, we only sell 3 calls. You'll see that of all these shares, we bought 3,900 shares. So we would have had to buy 39 puts. But if we only sell 7 calls instead of 39 calls, we take in $2,000 that more than offsets the price of the hedges in the index. And we have virtually limitless upside potential. Or what's even better, remember, if we were going to buy puts in the stocks, we would have had to pay $9,800. We were going to sell calls to get $9,800 back, and this would be a credit for the calls. But instead of hedging with the equity puts, we'll hedge with an index. And those index puts cost us $1,980. So now we have a $7,800 credit coming between our calls in the stocks and our puts in the index. That's where the credit's coming in. That's why we're getting almost $8,000 every month in credits, even though we have a collar on that's perfectly hedged. And why does this work this way? Well, when we're buying our hedges, what volatility are we buying on? You'll see in the top right-hand corner that the volatility in the SPX is a 16. But when we're looking at the equities, We're selling Amazon on a 32 vol. We're selling NVIDIA on a 74 vol. We're selling Dell on a 66 vol. So we're selling calls on a 75 vol, and we're buying our put hedges on a 16 vol. That's why we're getting all these credits. This is a beautiful thing. And that is when you're getting credits every single month, you have step three. Your returns are enhanced by 15.7% per year. Meaning if the market doesn't move, you're still going to make almost 16%. The market starts out 2025 at 6,000 in the SPX. The end of the year at 6,000. Your Coke made nothing, but your hedges took in 16%. So what is portfolio management? Now, this is my definition, and I'm going to give it to you real quick. It's going to be a little bit different than you're going to see in Investopedia or anywhere else because this is based more on experience and standing in the SPX pit as these big funds like Berkshire Hathaway come in and do their giant risk reversals to hedge their baskets of stock. Really, all portfolio hedging is a kinetic process, the active process of treating a bunch of stocks as your own index. Then you go out and you find a basket or index that most closely matches your stocks, and you use that as a hedge. From there, you can sell calls to collar it in the index. You can sell some in the index and some in the equities. You can do very few in the equities just to get your money back, but leave your upside potential to infinity. Or you can hedge even up and try to get 16% better return than the market as a whole. Now, even though we're putting on this trade all at the same time, we'll do the put side and then the call side within minutes of each other. You almost have to look at them a little bit differently. The put hedge is more straightforward part of the hedge. And in the class, we're going to be talking about the difference between a naked long put, a put spread, a put butterfly, condor, etc. A lot of my students want to get fancy and do like wide butterflies and dragonflies to lower their costs and get close to the money. I don't mess around with my basket of stocks. I look at most people's biggest investment in the world is their retirement account. Don't get fancy. Make sure your butt is protected. Anyone in California right now knows the value of insurance. Even though mathematically your house will never burn down, tell that to the people in California. Stuff happens, so I want protection. So the put side I'm pretty clean on, but the call side is where the art starts coming into. Okay. It's a little bit creative, a little bit mathematic. There's a balance between quantitative and qualitative hedging on the call side. We can do short calls in the index. We can do, like I said, a mixture of calls in the index and calls in the equities, all equities, etc., depending on what your goal is and depending on what the market's doing. In the summers, when the markets are dead, you're going to want to sell more calls. Get your income derived from a dull market from calls. In a crazy market, like especially the first week of February, the last week of January, first week of February, when the market really tends to shoot, you may want to limit how much upside ceiling you put in with call sales. You may want to lighten up some of the call sales and only get enough call sales in to offset the cost of your hedges. You can get as creative as you want. But here's the thing, and here's the really cool thing that I pointed out last night, or excuse me, the night before in class. I showed this to my students once before. And let's say you start out with a $30,000 account and you don't put any more money in it. And after 10 years, you get the normal estimated annual return of 10%, which is what the stock market goes up annually on average. Most people have heard on average the stock market goes up 10% a year. Okay, let's say you start with 30,000 and after 10 years, what do you got? 81,000. Now go to the bottom half of this slide and let's see what you get if you have the same 30,000, the same 10 years, but you instead of the market giving you 10%, the market gives you 10% plus you make 17% more on your hedges for a total of 27% returns. Well, now instead of in 10 years you have an 81,000, you'll have 433,000. A lot of people starting out late in life to worry about their retirement finds this unbelievably important and helpful and array of optimism. Why? Let's say you're like everybody else in this country. You planned for your future, but stuff came up. Illnesses, job losses, divorces, and you're not quite where you'd want to be comfortable enough thinking that you could retire and not have to worry about money. Well, if you have 433,000 and you get 27% a year, that's 10 grand a month coming in without touching your principal. Just hedge every month and live off of that credit. And I told people, my students, I'm going to be doing this. I'm offering this to my brother. If he wants to accept, he's going to let me know real quick. I'm going to give him $30,000. Okay, he's the greatest kid in the world. He's got the greatest life in the world. He's so much more relaxed than I am. He's a ski instructor out in Colorado. He teaches snowboarding. Can you think of a better life other than maybe a surfing instructor in Maui? He doesn't make much money, doesn't save much money, but he has a great life. I am going to offer him $30,000. He does this for the next 10 years. When he's about to retire, he should have 433,000. And as he learns this, he won't need me anymore. All he keeps doing is when he gets to 400,000, 500,000, what have you, keeps doing it. And every single month, he's going to be taking in $10,000, just like a pension would. So you may see him in the mini class this Saturday. And to show you how powerful this is long run, look at the y-axis on this chart. This is Berkshire Hathaway, which is Warren Buffett, versus the S&P since 1965. Okay, 60 years ago. This is what a little bit better does hedging with indexes and getting slightly better returns than the market as a whole does over the long term. Look at the y-axis. That's the important thing here. Because you look at these lines and you're like, well, yeah, Warren Buffett in red is doing better, but you don't really get this concept of the scale of how much better until you realize I take this line and go all the way over here, and I take the line of the S&P. There's a big difference between, say, 11,000 and 150,000. That's how much better Warren Buffett is doing the approach we're going to be teaching on Saturday. It's crazy when you get into compounding what a couple percentage points difference makes. Okay. Now, I'm going to wrap this up because the market's going crazy. I know some of you guys want to get back to it. Again, no high pressure sales. Sign up if you want. Don't sign up. I'm just letting you know because We have so many people that Tom um, shares with us that they actually get mad when we don't let them know that we're having a class. They find out about it later and they can't participate live. They can only get into the recording. We already had our early bird special, but we're extending it because we didn't have this roundtable until today. So until the 19th, we have a midnight deadline. We'll give everybody the $4.99 rate. After midnight, it's going to $5.99. So it's going to cost 20% more after um in 2 days. That'll be the airmare discount. $100 off because you see at the bottom on our flyer, it goes to $5.99.
I just
You
posted the link Glenda gave me into the chat,
Oh,
so
okay. Yeah, you
yep,
can see that the January 10th early registration's already expired, but we're extending it for your people.
appreciate it, Scott.
Okay. Tom, your people are great. I've only run into one difficult person with your group as opposed to two difficult people with my group. But so
That's not many.
you're doing better than me. But I'm still blessed considering, the hundreds of names I go through. Um, so again, today's the 17th. It'll be a week from tomorrow. The class will be recorded. That is, we limit the seating to 100 people in the room just so that I can actually answer questions along the way. When you have more than that, all texting questions and stuff, it just becomes a mess. So that's all I got. We're gonna sell out one way or the other. I'm not gonna, tell you you're gonna die if you don't take the class. So sign up immediately or anything else like that. If you want to come in, we'd love to have you. If not, still wish you best 2025 you ever had.
Is there,
So
I know people might have this question, is there any
yeah,
ongoing trades or support for the class going forward? Like,
that's a great question. You know what? Glenda just asked me that same thing last night. Well, she knows the answer, but she asked me to explain it, and I didn't. Almost every single mini class we have one or two trades as a bonus afterwards. Like if when we were teaching alchemy, I did a trade and then cleaned it up with alchemy and left on free butterflies everywhere, butterflies for credits everywhere. The day trading class said we'll have a whole day where I just day trade and people watched me day trade and put on a giant tent where we made like $1,500. And that's the best way to learn is watching it be done. This is a little bit different though, because of the amount of steps required to go through, come up with the portfolio, stick everything in a basket, come up with the hedge, put all the trades on. It's a lot of work. Now I am going to be actually doing it. Um, we just got done with PLTR collar, where after the collars class, we went into NVIDIA and then PLTR. And in the middle of August, we bought PLTR and we hedged it up until the end of the year and then rolled it into a call instead of stock. And people went nuts. They were reinvigorated with collars. I don't teach collars that much because I think people pretty much understand it and they're boring. And once again, I'm proven wrong. People love the nuances and how to really trade them as opposed to just slapping on the garden variety dollar cost neutral. So we did a NVIDIA long call instead of stock. We did a NVIDIA long put instead of short stock and made money. Then people wanted to do a long-term trade, and we went in and had a long-term, August until the end of the year PLTR, and we like doubled our money because this, you know, since August, and people just, okay, that's it, Scott. So we want more. And when I showed the Warren Buffett method, literally people were blown up and they're screaming at Glenda to open the class. They want to sign up. We didn't even create a class yet. I mean, this was like I was being normally people have interest. I create the class. if people had the interest. This one, people were like demanding that we create the class. I'm like, I'm not sure I want to teach this. I'm like, you're doing it. So I'm like, okay. And this is literally, without exaggeration, not a sales pitch, the biggest class we've ever had, filled up as fast as we could. Um, the most interest, the most emails asking questions, the probably twice the interest of any class we've ever had. And I think it's because most people own stock in their retirement account and they know that they could be doing better than they're currently doing. And as great as collars are, normal collars, they know the pros are doing something more esoteric and efficient. And even though I did PLTR collar, like textbook, where we were long puts, short calls, rolling our calls as the market went up, etc., textbook, and we did extremely well. It was a lot of work, and people want a more efficient way that gives better returns with less work. And so the problem is to do this requires so much work. We're going to have to go out and I'm going to have a go-to class where I'm going out and buying all the stocks that we pick. The students are going to pick the stocks, they're going to pick the dollar value, they're going to pick the quantity, and then I'm going to hedge it. That's going to take a couple hours. Then anything can happen. What am I going to do? Show you it for a week or two? Nothing's going to happen in a week or two. We could have a week where the market doesn't move and nothing happens and people aren't going to learn anything. So we're going to be doing a 5 or 6 month class on this, just like we did with PLTR, where I don't know what we charge, 150 or something a month to follow the trades. If you're not in pot, if you are a member of our pot class, you get it for free. But it's a nominal charge, and then you get all the updates of what we do and stuff. But to give a little sample, like at the deli counter, you just can't do something with this many moving parts as a sample. It just doesn't show a fair representation of what the trade is.
Sounds
Was there
good.
was there any other questions that I missed?
Oh, I like the T38, by the way.
Yeah, Talon went by.
Yeah. No more questions.
Okay.
It sounds like a great class, and yeah, I
You
look
know what?
forward.
It's like serendipitous. Okay. I think I know what the students want and what's really cool and what's going to give them the best bang for the buck in terms of need to know to become better traders. And then out of nowhere, they beat me over the head with a stick and say, "This is what we want." And that's what we're getting with this class. I mean, and it makes sense if I think about it, because the squeaky wheel gets all the noise or all the oil, right? So a lot of my students are just asking a lot of zero DTE questions and stuff. So I assume everybody is based on the the data coming to me and the information and the questions, teach more zero DTE stuff because that's the feedback I'm getting. It's not until a topic comes up that just blows you away with interest that applies to almost everybody in the country who's ever had a job that you realize I was too close to the trees to see the forest. This is more what people want. And, you know, ironically, it was just by accident that I even brought this up. And it was just, a different class that people asked a question about, went on a tangent. And the next thing you know, it just became a thing greater than anything we've ever had before. And the cool thing is, I do this trading for myself and Glenda's account is just starting to do it without her knowing really how to do it because I help her with her account, but she's going to be in this mini class as a student because she started out I mean, you probably remember her from years ago. And
Sure.
everybody asks, what's your favorite trade, Glenda? You know, I don't trade. Why would I trade? Scott's here. I'll let Scott do it for me. But she's become a junkie, you know, and she's constantly throwing more money in her accounts and retirement accounts. And her favorite day of the year is January 1st, where she can throw more money to play with that in her retirement accounts. She's going to be doing this with her portfolio because she's got, I think she's seven, eight stocks now. She's in PLTR. She owns Tesla. She owns this. Why go into eight different names and hedge every single month? You can go into an index, boom, you're done. One stop, and then sell calls. Tesla has a big day higher, sell calls. It's a beautiful thing.
Yeah, sounds like a really great class. So I hope people take advantage of the special that you you gave through the Airmer links. Appreciate it, Scott.
Oh, always happy to do anything for you, Tom. I just hope your wife is feeling better. That stuff is always health is always more important than money.
Oh, and your dad too. So yeah, we're all
Yeah, he's in the hospital, but he should be fine. His is just COVID related.
okay. I hope he
So
recovers soon.
thank you.
Well, thanks very much. And
Okay.
we don't need to keep people here, but I'll put all
No.
the links on the recording and hope everybody takes advantage of this great
Yeah,
class coming up.
yeah, thanks for participating, everybody. Have a great 2025.
You too, Scott. Thanks,
Okay.
everyone.
I'm
And you
always
too,
excited
Glenda, if you're
about New
still
Year.
here. Yep.
Take care. Bye bye.
Bye.